Changing gears a little bit, you've been speaking recently about something called fiscal dominance. And this is something I've also been kind of watching closely for a while. For those who aren't familiar with what this means, why does it matter? And how do you see it impacting what looks like a bull market in equities, what looks like a bull market in Bitcoin? How do you see that playing out? In other words, does anything stop this train?
Right. So fiscal dominance is one of the kind of rarer economic scenarios that developed markets find themselves in. And most investors in the past 40 plus years or so have not really traded those types of environments. Generally, it's kind of something for the history books or those that are familiar with emerging markets are more familiar with the concept. Basically, if you go back to the two major sources of money creation in the fiat system, right? There's base money, there's broad money. How does broad money come into being? And the first method is that banks lend it. They lend money into existence. They kind of lever up the base money by creating more deposits by lending. Um, and for example, the 1970s, which was characterized by rapid money supply growth and rapid price inflation, the bulk of the money creation came from bank lending. And that was because baby boomers, which were born starting in the early 40s, were entering their home buying years by the early 70s. And because kind of continuing throughout the decade, you had a wave of home construction, of credit creation, of money supply growth, and then up against kind of supply constraints in the energy sphere. So that's an example of lending driven inflation. On the other hand, you can run very large monetized fiscal deficits. So, for example, the 1940s, when the United States is fighting World War II, they can spend a lot of money into the economy, issue a lot of bonds to do it, have their own central bank buy a lot of those bonds. And so you're spending money into the economy that you're not really pulling out of the economy. And therefore, regardless of whether banks are lending or not, you can inflate the money supply and inflate commodity prices, asset prices, wage prices, all sorts of things like that, and have another type of inflation. And when we look at the 1970s again, when the Fed's kind of managing inflation, almost all of its tools are about the first type, bank lending. They don't really do much about the fiscal side. And so, for example, in the 70s, public debt as a percentage of GDP was like 30%. And most of the money creation was from bank lending. And so if they raise rates and do other things that kind of
Yeah.
convince banks to slow down bank lending, that should generally be disinflationary and recessionary. And, they might, for example, increase the public interest expense a little bit, but because it's low to begin with, it's a much smaller effect than the dampening effect they're doing on bank lending. Whereas when you fast forward to the current era, if you're over 120% debt to GDP in the public ledger, if you increase interest rates, you might slow down bank lending to a moderate degree, but you also completely blow out the fiscal deficits because of all that interest expense. And so the Fed's tools become less effective and at extreme events can even become pro-inflationary. They kind of the tools either stop working or in worst case scenario, they actually start working backwards and they kind of are not really able to deal with it because the source of inflation is not from bank
Yeah.
lending, it's from out of control fiscal deficits. And so what we see is in kind of the Western world in general, and especially the United States, structural deficits as far as the eye can see, and higher interest rates only make those deficits bigger. And so that tends to be a more structurally kind of pro-inflationary type of environment, either for commodities, wages, and things like that. Or if there's enough disinflationary offsets, cheap energy and AI and things like that, then instead a lot of that money can get into asset prices, tech stocks, Bitcoin, assets like that.
Yeah. And so, I mean, and this is an area, this is something that I think so many market watchers got wrong, right? They saw this Fed that was behaving, very aggressively. They were hiking rates. They were, fastest pace of rate hikes that we've seen in a long time. And a lot of people took that as like, okay, there's going to be this huge economic contraction. Markets are going to crash. We're hitting a recession. But I think like what they missed and like what you're saying has gone on is the fiscal authority, the government behind the scenes has been issuing a ton of debt, spending a ton of money into the economy. And you've described this, it's a self-reinforcing cycle where actually the higher that the Fed raised these rates, the more it increased the deficit, the more it increased kind of the interest expense for the US. and then they have to issue more debt, and they have to spend, more money into the economy. And this is, I think in many ways, this is money that really gets into the economy in a stickier way too. So it's something that I think so many people got wrong. For those in the audience that are still kind of in that first camp, right? They're still really worried that we have these high rates and that's going to be really contracting the money supply. What would you say to those people as they're navigating their investment journey?
I would say it's important to be data dependent, and I was there with them for a period of time. So, for example, in early to mid 2022, I was expecting and writing about recession. And we were seeing that in a lot of the data. We were seeing a lot of rate of change indicators about the economy roll over. We saw falling purchasing managers indices in the manufacturing sector, contracting commercial real estate, just kind of decelerating economic indicators across the board. Um, and so that was right for a period of time because the monetary tightening was bigger and faster than the fiscal for a period of time, about a year. But by the time we got kind of late in that year, and especially by the time we got into early 2023, it started to become more evident that the fiscal side was becoming large enough and overcoming, or at least balancing out, the monetary side. Partially because, as we just talked about, the monetary side ironically makes the fiscal side even looser. So the tighter you get on monetary, the looser you get on fiscal, assuming you have, say, well over 100% debt to GDP like we have now. And so once there were kind of early signs of that taking over, it became time to change and say, okay, we were heading towards recession. Now it's more mixed. That was kind of my stance for a while. And then after enough period of time of that, it's actually starting to become even a little bit more balanced towards the fiscal side. That doesn't mean that there's not challenges ahead. I think another way of looking at it is that right now we have an unusually sharp divergence between loose fiscal and tight monetary. So I think an easy framework to think of is that you're likely going to see larger than normal divergence between sectors because some sectors are more dependent on interest rates and others are more dependent on fiscal. So for example, commercial real estate it's impacted by work from home trends, but then it's also, they have short duration debt that gets refinanced and causes a lot of problems. It's very interest rate sensitive. So that's certainly a sector that's in ongoing recession mode, having a really bad time. And there's other sectors like that as well. But then there's other ones, for example, travel and dining, right? That's, the people doing a lot of that are on the receiving side of a lot of this interest expense and a lot of Social Security and Medicare and all these things that are kind of pouring into the economy. They're going out and spending it into the economy. And so there are other kind of more service-oriented sectors that are doing fairly well. And thus far, those sectors are bigger than the ones that are in trouble. And
Yeah.
so I wouldn't really think of it as the economy as a whole. Just think of it as sector by sector by sector, and then add up which sectors are more affected by fiscal versus which ones are affected by monetary.